When markets are at their calmest, the seeds of the next crisis are already sprouting. This paradox of financial decision-making has destroyed more wealth than almost any other investing mistake. Here's why it happens and how to avoid it. In the dance of human behavior, we're caught in an eternal cycle of extremes. Welcome to the dangerous cycle, how today's calm creates tomorrow's chaos. We humans swing perpetually between greed and fear, optimism and panic. When markets rise, we feel invincible. When they fall, we're gripped by terror. This emotional pendulum drives our decisions in predictable yet destructive patterns. History reveals this truth with brutal clarity. Before the 2008 financial crisis, markets celebrated record highs amid a housing boom that seemed unstoppable. The dot-com bubble of the late 90s saw irrational exuberance push tech stocks to absurd valuations. And in 1929, before the devastating crash, investors believed prosperity would never end. In each case, extreme optimism preceded catastrophic downturns. But this cycle extends far beyond financial markets. We see it in relationships, where complacency leads to breakdown. In careers, where success breeds overconfidence until failure strikes. Even in health decisions, where feeling invincible leads to neglect until crisis demands our attention. This universal pattern, this dangerous cycle shapes our lives, whether we recognize it or not. Understanding it is the first step toward breaking free. Have you ever noticed how quickly we adapt to success? Our brains are wired to normalize positive circumstances with remarkable speed. A promotion that thrilled you last month becomes your new baseline expectation. This hedonic adaptation rewires our neural pathways, making today's extraordinary achievements tomorrow's minimum standards. But that's just the beginning. Once we've tasted success, confirmation bias kicks in. During market booms, investors routinely dismiss warning signals while amplifying positive news. In the 2009 dot-com bubble, people ignored basic profitability metrics, focusing instead on skyrocketing valuations. In 2008, home buyers convinced themselves prices would rise forever, filtering out contrary evidence. Perhaps most dangerous is how these beliefs spread socially. When everyone around us shares the same optimistic outlook, doubters are silenced. Conference rooms become echo chambers. Social media creates feedback loops of collective optimism. Studies show we're 1% more likely to make risky decisions when our peers validate our thinking. This perfect storm of adaptable brains, selective perception, and social reinforcement explains why good times feel not just good, but permanent. And this perceived permanence sets the stage for the next chapter in our dangerous cycle. Between calm and chaos lies a dangerous middle ground, a twilight zone of denial and panic. For individuals and institutions alike, the process begins subtly. Early warning signs appear. The unusual data point, the troubling market signal, the expert raising concerns. Yet we're remarkably adept at dismissal. It's just an anomaly, we say. The models don't predict any problems. This collective denial feels comforting, but beneath the surface, pressure builds. Like a pressure cooker with a blocked valve, the longer we ignore problems, the more explosive their eventual release. This is the psychology of panic, the moment when reality can no longer be contained. Consider how market crashes rarely arrive without warning. There are always indicators, always voices of caution. But they're drowned out during periods of calm, only to be frantically acknowledged when it's too late. This pattern repeats across history because denial isn't just cognitive, it's emotional. We crave stability and resist threatening information until the evidence becomes overwhelming. Then, panic takes hold, amplifying the very chaos we sought to avoid. Breaking this cycle requires uncomfortable vigilance, especially when everything feels fine. When disaster strikes, something curious happens to our minds. Trauma doesn't just hurt us once, it rewires our entire risk assessment system. After experiencing significant losses, whether financial or personal, our brains create neural pathways that prioritize threat detection. We begin seeing danger everywhere, even when it's statistically unlikely. This is why bad news feels so permanent. This psychological scarring has real economic consequences. After the 2008 financial crisis, millions of potential homebuyers remained on the sidelines, convinced property would never recover. By 2015, those same homes had often appreciated 50% or more. Similarly, investors who fled the market during COVID's outbreak missed the remarkable recovery that followed. One study found the average investor who stayed out for just 6 months sacrificed over 30% in potential returns. Perhaps most fascinating is how pessimism mirrors optimism's flaws. Just as we convince ourselves bull markets will run forever during good times, downturns create an equally stubborn certainty that recovery is impossible. We entrench ourselves in pessimistic worldviews, dismissing positive signals as temporary anomalies. This mirror image thinking creates the dangerous cycle at the heart of our discussion, where today's calm plants the seeds of tomorrow's chaos, and today's chaos convinces us calm will never return. In a world of cycles, breaking your own personal patterns requires deliberate action. Let's explore how to disrupt the dangerous cycle where today's calm creates tomorrow's chaos. Start by recognizing your position in emotional cycles. When everyone's optimistic, ask yourself, what could go wrong? When fear dominates, consider, what opportunities am I missing? This counter-cyclical thinking positions you ahead of the crowd. Build emotional resilience through practical habits. Maintain a decision journal, tracking your predictions and the actual outcomes. Practice scenario planning by imagining multiple futures, not just the one you hope for. Deliberately seek viewpoints that challenge your assumptions to develop contrarian thinking skills. These practices create psychological distance from market extremes. Finally, establish personal warning systems. Create a dashboard of indicators that signal when you're becoming too greedy or fearful. Set specific triggers like portfolio adjustments when assets rise or fall by certain percentages. Designate a trusted friend as your sanity check when emotions run high. Breaking your personal cycle isn't about perfection, it's about recognizing patterns and creating systems that protect you from your worst impulses. In doing so, you transform today's awareness into tomorrow's advantage. Balance is your compass in life's journey. Recognize when calm breeds complacency and use that awareness to create positive change instead of inevitable chaos. How do you maintain balance between comfort and growth? Share your strategies in the comments below. Subscribe to RockVein for more insights on life's paradoxes. And remember, awareness breaks the cycle.